Hello, welcome to the May 2023 market update. We're going to try and give you a concise yet important summary of what's going on in the market. This is the team, you know us. I'm Victor Connor. This is
Max Westerman.
All right. And Max, what do we do for everything? What's the underlying thesis?
All right, our underlying thesis, Victor, is number one: 90% of the things you worry about never come to pass.
I was worried about that.
90% of it never happens. Number two, the result: we make observations, not predictions.
And I heard that from Fed Chairman Powell today, and the same thing. Okay.
Number three, Occam's razor usually means the simplest explanation is the best one. And finally, supply and demand applies to markets as well as products.
All right, let's get down to it. Here we go. Close of business yesterday. This would have been Thursday. Dow was down up for the year a half a point, not even a half 0.36. S&P 500.
S&P 500 was up, let's say 9% for the year.
And the big boy, Standard & Poor's, NASDAQ, NASDAQ, the over-the-counter traditionally market, heavy in tech, up a little over 20%, led by Apple, Amazon, Google, Meta, and NVIDIA. Those are the five that are really leading the NASDAQ now. So let's move it on. Here's the Dow Jones Industrial Average. I'll do the Dow. We'll get the Max to do the S&P. A couple of things in there. Important. Upper left corner. You see yesterday's price, 33,310. Then you see down towards the middle of the other circle, October 13th. That was a great day in history. The Dow was down 28,660. Think of that. We've gone up 5,000 points since the low in October. And if you listen to the media, you wouldn't even know it. Yes, we've gone sideways year to date. Like we said, the Dow was up 0.36. You have a couple of big indicators. The top one, the 20 DMA, daily moving average, short-term indicator. Then you have the 500 DMA, basically a quarter, and the year, the 200 DMA. They're all turning positive. A key technical indicator, down in the lower right, the Golden Cross. What's the Golden Cross, Max?
What's the Golden Cross? It's when the 50-day moves over the 200-day and creates the Golden Cross.
And that's a really important thing.
It's an indicator of basically a bullish market. And then if you go on the downside, it's the death cross if the 50-day moves through the 200-day moving average.
So very significant technical indicators. Standard & Poor's 500. This one's for you, Max.
All right, this one's for me. So
I said that. Oh, okay, go ahead.
As you can tell, 518 yesterday, with the S&P was at 4169.
Yep.
And then on 1013, Victor's birthday is 1013.
Right. That's a good day in history.
Good day in history. Victor blew out the candles and said, "I want the market to go up," and boom, market goes up 341.91. Went right up, and now we're at 41.69. So as you can tell, it was a little chop, but it started going up, and now we're at there. And Victor just went 20, 50, and 200-day moving average. You have the Golden Cross that correlates to what the Dow was saying, and that's important to look at.
And then right now, this is who's leading the indicator. You see most of the trends are up. This is the NASDAQ, the over-the-counter, heavy in technology. Again, Apple, Amazon, Google, Meta, and NVIDIA are really moving this average. Those are the ones that are moving and
that are moving the average in the upright and upward trend direction.
He said just what I meant to say. Okay, so let's go on. Big issue, 2022, lousy year. Nobody liked it. We didn't like it. You didn't like it.
The shorts liked it.
The shorts liked it. The big issue was the Fed raised interest rates 20-fold. Think of that, from 0.25, a quarter of a point, to 5%. That's a 20-fold increase in short-term rates. That's not only hammered the banking industry, that's what caused all of 2022's damage. And what were they after? Inflation. But look at this. This is the Bloomberg Commodity Index. It is, if you will, the Dow Jones Industrial Average of commodities. It's gone from 135 to right now 100.96, a 25% drop since July. Now, we're not going to go through all of these. What's up there, though?
The 6 up there, we got in the top left-hand corner. That's crude. You can see that's in a downward trend right now. We got coffee downward trend. All of these are in a downward trend, as Victor just talked about. But except we're not seeing that really affect us, the consumers, personally yet with
coffee price. I haven't seen Starbucks or
Dunkin' Donuts
go down.
Yeah.
The nerve. Okay. So they peaked. They peaked back in July. Now, here was the key. This is last week's action. The Federal Reserve Board raised rates 1/4 point and signaled a potential pause. The biggest statement they said, Max.
Biggest statement they said, in a hint that officials could pause rate increases after the latest move, they cut a phrase from their previous policy statement in March that said some additional policy increases might be appropriate.
That's what they took out. So watch what they do, watch what they say, and watch what they don't say.
So 3 things?
The 3 things. That's it. That's a triad. So what's happening with inflation?
All right, inflation. Inflation is slowing. Excuse me. And we'll see in a later chart what inflation has done over the past 3 years. So inflation, the consumer price index, it was at 4.9% in April. The reading has declined from a recent peak of 9.1% in June.
That's almost in half.
Almost in half.
In half since the peak in June. We've gone from a little over 9 to about 4.9.
And people will say CPI, that is the consumer price index.
Okay, so let's see what's happening now this month in the market. First of all, housing prices. Tell them about housing prices.
Housing prices, they've gone down. They're starting to tumble down for like a ton of bricks. Home prices posted the largest annual drop in 11 years.
In how long?
11 years. That's huge.
Wow, that's huge. Yeah, okay.
So, U.S. existing home sales, which makes up most of the housing market, fell 3.4% in April alone, from the prior month to a seasonally adjusted annual rate of 4.28 million. Housing prices are collapsing, and that's good for the CPI, which makes up about 40% of rent of the index.
You look at the consumer price index, as Max had just said, 40% is rent and housing. Now, those of us here in South Florida's a little bit different. Everyone else in the north is moving south with the
in the west.
In the west, yeah.
California.
Yeah, they're moving out of California.
And Washington.
Yep. Oh, never mind. Okay, go ahead. So, yeah, housing. Here it is on a chart. You look over to the far right on the chart. When it's under that line, that was 2007 when prices turned negative. Then you had starting in 2020 when we had COVID and the work remote movement, housing prices shot up, and now you can see that mountain. They're heading back down. Okay, mortgage rates.
Mortgage rates. All right. The top one, 30-year, middle is 15. The bottom one's 5. So the top one, the 30-year, which most people go off their mortgages, that's gone up from the peak of 7%, and it fell. Now it's down to about 6.5%. So it's falling. The average person for most people, it was about 7%. Josh, myself, your grandkids, we've probably are used to around 3%. You guys, the historical average is around 7%, though.
Yeah, some of you remember back 79, 80, 81, we had 15 and 16% mortgage rates. I remember clients calling in and taking large sums of money out to help their children buy houses. They don't do that anymore. Why don't they do that anymore, Max?
Because they never got the money back?
No, because the kids aren't buying the houses. The kids are moving back home.
Yeah. No, I'm saying when you usually give a loan to your kids, you don't.
A what?
A loan to your kids. You don't get the money back.
Yeah, because the money is a loan. You'll never see it again. Okay. Core, Consumer Price Index, year over year.
All right, so the core CPI, we just talked about this. It's dropped. We were at 9.1%, and it's gone right down to about just over 4.5% now. So it's falling with a significant amount of it is housing and rents. Makes up again around 40% of it.
I want you to notice that chart. You're going to see it was real low for a long time and took that big run. Watch what the historical interest. Oh, we're going to get to that in a minute. Okay, we're going to show you the historical interest rates. Bank contagion. You had SVIB go down. You had First Republic go down. Right now, we haven't had any bank problems in the last 2 weeks, but there's been a significant change in regional bank problems. No longer is it the FDIC coming in and rescuing the bank. It's the larger banks, the JP Morgan, Bank of America, Citigroup, are buying them. So that fear of bank contagion has slowed down considerably.
You know what, Vic? Bank contagion. If we have any audience members out there that are directors or producers, that could be a movie
That
title.
could be a movie. That'd be Twilight Zone. Look,
Yeah.
the banks, they're all contagion. Okay, good. So inflation.
So inflation. So has the Fed been successful in slowing inflation?
Yes.
Yes.
Okay.
Where are we now?
Boynton Beach.
Boynton Beach.
Oh, no, I'm sorry. Okay.
Let's look at the actual numbers.
Now you got to watch this. I showed you the chart a minute ago. Oh, am I going the wrong way? Sorry. Okay, there we go.
All right, so from 2000 to 2020, this is what I was talking about before when look a little farther in the front of the slideshow. The average inflation rate was at 2.18% for 20 years.
For
From
20
2000
years.
to 2020, 2.8%, 2.18%. By 2021, it more than doubled, 4.75. 2022, it peaked at 9.1% in June of 2022, and then now we're coming back down. Now we're at about 4.75.
Yeah, on that last point, it peaked at 9.1 June. It's supposed to be 2022. That was my typo, so I'll take responsibility for that. Okay, latest Federal Reserve. We covered this. This is yours again then.
Okay, so the latest Federal Reserve, the Federal Reserve hiked rates again by 25 basis points, signaled this may be the end. We shall see. Many believe this was the one and done. The notable line that the Fed put in their press release from the prior press release was that they removed the phrase, the language, the additional increases were anticipated. They removed that from the prior press release, so that we're hopeful, fingers crossed, the Fed isn't hiking rates anymore.
Big signal. I'm not going to cross my fingers because they're won and they're done. Okay, inflation. This shows inflation. Now, Josh, are we going to have you say something on that? Did you get the camera worked?
I could say something on it.
Go ahead and say something. This is Josh's favorite chart, so I'll let
This
him
is my
think.
favorite chart. Hi, everybody. I'll let you guys talk about it this time, and I'll have the speech prepared for next time. But they can't see me.
Okay,
this
so
time
what do
around.
we have here? You can see all the peaks and valleys. Inflation goes up, inflation goes down. It is a normal situation. You see some of the big crises down there. You see the Great Depression. You see the Japanese financial crisis. Japan's always a wonder. They're just still having trouble. Their 30-year bond and the Japanese bond is still under 1%.
It's kind of crazy. They actually just hit on the Nikkei, I believe. I was reading this.
They're high.
Yeah, they hit the pre-bubble high in 19.
Of the market or the
from-
rates?
Of the market.
Oh,
The
okay.
market. They hit the pre-bubble market high that they had back in like 1990, which is kind of crazy to think about.
Yeah. And then finally at the end you had the great COVID recession. Why is something as lousy as COVID called a great? Should be the lousy COVID recession. All right.
I mean, we called it the Great Depression.
Yeah, but I don't want to. The lousy depression. All right.
The future.
We've talked about what's going on now. We've talked about the past, and now we go to the future. SpaceX, Elon Musk. I want you to look at those. Elon Musk has now launched, and I still get them mixed up. We have the Heavy and the
Falcon X
Falcon X. If
Yeah,
you live in
and the Starship.
and the Starship.
We have the Starship. We have the Starship Mark 1. We have the Star Hopper, and then we have the Average Male, which is 5'9". The Average Male.
Oh, you're seeing the Average Male. Look all the way down
We
there.
launched the average male into space.
We did launch the Average Male into space.
He was
But no,
5'9"?
The Starship is the one that the largest rocket we've put up.
We watched that at
space.
First Watch. That was the first watch we did. Out of Houston, went up, and you saw it had a successful launch. Then it all exploded. They called that an unplanned disassembly. Okay, and
$450 million
Oops.
successful launch.
Exactly.
It was a big boo-boo. However, they did learn a lot from it. And
If I just lost $450 million, I'd say I'd learn something too.
Well, the thing is that they like blew up their launch pad. It created the thrusters created a crater in the ground.
Did it?
Yeah.
There are 31.
I thought it was 32.
Call it 31 and a half. I'll meet you in the middle. 31 or 32 rocket engines in there. And I'll tell you, I'm a pilot, so what amazes me, look at those rockets. They don't have wings that stick out. They've got to coordinate the thrust from 31 or 32 different rockets just to make it go straight.
And they don't have thrusters on the side.
And they don't have thrusters on the side like a boat does. So it's absolutely amazing.
It's really interesting. Instead of a thruster system, they actually have these almost like fin devices that have holes in them.
Underneath? You mean in the bottom?
No,
Oh.
on the sides. If you ever look at a Falcon 9 rocket landing, coming back, it has these like grate systems. It looks like a grate, and that's how I guess they maneuver
The thrust.
the thrust with that.
Yeah, and then the next one that's coming off of is supposed to be in it. The big boy in July is coming off Cape Canaveral.
Yeah, the big. There's going to be the Falcon Heavy in Cape Canaveral in, I believe, early July.
Early July. It's supposed to
And
be a week
then,
ago, and they rescheduled it. I'm
yeah.
going to try and fly up there and see if I can get it from the air.
You're flying in it?
No, I'm going to fly by and wave hello. And then I'll wave to the two fighter jets alongside. Well, one alongside and the other behind me. Say, oh, sorry.
But they can't keep up with you.
Yeah, they can't. He's right. You know why? They can't go that slow. All right. Big issue. Chat GDP. I'll let you do it, so I'll talk on the next one.
Okay, ChatGPT, it's affecting everybody's life. How is it affecting yours? We've talked about ChatGPT before. It's the topic of conversation right now within Washington. We had OpenAI, the CEO, testify in Washington this week. We'll see what legislation they come out with. Hopefully they come out with legislation. The CEO actually asked for legislation. But right here we have ChatGPT. We'll see you now. Doctors are using AI to answer patient questions. So they're using AI right now to answer questions with doctors and see how they can help with your illnesses and how they can help you. So
and how they can predict ahead of time. They can make diagnosis that way ahead of time. So they're having a lot of impact in the medical industry. But two things I'll say. First of all, what's the A in AI stand for?
artificial.
Artificial intelligence. You still need people. If you don't think you need people, when's the last time you've ever known anybody with a computer that didn't need tech support? You know, so yeah, but it's good. But here's the deal. We're not fighting it. We're using it. We're trying to use it to our advantage. As technology goes forward, you need to adapt and improvise. And I'm going to show you right now.
How did we adapt and improvise?
Here we go. This is how we adapt and improvise. We've been doing estate planning for 35 years. In the old days, you came in, you gave me your trust, took me an hour to read it. Then I had to make sure I was up on all the current laws. Then I had to look for who were your successor trustees. Was everybody good? What are the issues? How are you doing it? Now, watch this. Now, using a new program we have, new software, we feed your trust in there. About 20 minutes later, we get an estate snapshot. It gives you a flow chart. When one person dies, this is how the money goes. Another person dies, this is how it goes. It makes it very easy for you to understand the structure of your estate. It simplifies it, puts in one elegant report. And here's a big issue. Planning opportunities are identified. What are planning opportunities? Well, we happen to notice in here that your brother is your successor trustee. The problem is he died 5 years ago. So a lot of people don't think about this. But this lets you look at it and uses artificial intelligence to go through it, find out the issues you need to look for. Everything might be fine, but you don't know what if they can be difficult to read. Go ahead.
And what it also does is it keeps current with the current tax code and the current estate planning laws. So it can say, it'll be more efficient and on how to get
Pass it on with the least amount of taxes.
Exactly. Pass it on with the least amount of taxes and more efficiently.
Yep. And in theory, in 2 years, in 2025, the estate taxes, remember when Trump did the tax return, rewrote the laws, the personal side only went for 10 years. They expire in 2025. In theory, if they don't do anything, in 2025, the personal exemption, which is now a little over 12, goes to what?
Goes to 6.
Goes to 6. It cuts it in half.
And it's 12 per person, and then it goes to 6 per person.
Yeah, so
per social.
We'll end up. And by the way, I forgot to say this. You said the CEO for artificial intelligence was up at Congress.
Yeah.
That's because in Congress, the only thing they have is artificial intelligence. I couldn't help myself. I'm sorry. Okay, here's the big boy on the block. We're all hearing about this. And the purpose of this slide, if you look on the slide on the left, no breakthrough in the debt ceiling. This is May 6th. News comes out, the market is terrible. We're not going to have literally the next day, stocks rise on powerful debt ceiling update. It's going to go back and forth. One day it's going to be good news. One day it's going to be bad news. They're both meeting as we were filming this. The Republicans walked out saying the White House wasn't serious. So the market turned around today. It's going to go back and forth. They're going to get it done, but it's going to be 11:45 on whatever date. I mean, it's interesting. Right now, where'd the June 1 date come from, Max?
The June 1 date is just made up, and Janet Yellen basically said, we came up with a date, June 1, we need to have this done. By her estimates, she's buying herself time, and because that isn't the actual date, there's some analysts that say, oh, we can have August.
Go to August.
And we'll be fine. So Janet Yellen's just trying to buy time, saying, you need to start talking about this. That's why she put down the June 1 date.
So whatever happens, whatever date they pick, I'm going to tell you right now, it's going to be 11:45 that night. They've just finished shoving Grandma off the cliff, and they're going to come to a resolution. It's 78 times. Is that the next one? Here we go. I'll let you do that. Okay.
The United States debt ceiling has been raised or suspended 78 times since 1960. So as Victor was saying, it doesn't matter if it's the Republicans or the Democrats. They've come to an agreement. They've pushed it forward 78 times since 1960. It's complicated, complex negotiations, but they get it done at the 11th hour.
11:45.
Oh,
okay.
Sorry, 11:45.
Okay. This is the history of bulls and bear markets. And the reason we're doing this is a pattern that has existed since 1926. We only got 97 years of history. But I want you to notice on the bottom, this is busy. We're going to simplify it in just a minute. The red circles on the bottom are bear or down markets. The average statistical length of a bear market is 11 months. Every time in the past, every single time, only for the last 97 years, every time there's been a bear market, it has been followed by a bull or up market averaging 6.5 years. And the numbers are basically, I'll just round it out, 6-1 on the bull markets over the bear markets. So that's charts busy. You see all the blue mountains on the top? Those are the bull markets. You see the little ones, orange ones on the bottom, those are the bear markets. Those gray lines are recession. So let's summarize. Take that all chart and it boils down to this.
So summarizes that bear markets are 11 months, like Vic said, 11 months. Bull markets are 6.5 years. You can't time the market though. That's why it pays to be invested. From 2009 to our last bull market, great bull market, was 10 years. And it was up. We're up 400%. So
bull markets you could call great.
Yeah,
None of
bull
the
markets you could call great.
None
Yeah,
of the
exactly.
Great Depression or Great COVID. Bull markets we'll call great. So, and this bear market is now long in the tooth. And when you compare it to other things, you compare it to 2000 to 2003, the dot-com bubble. You compare it to 2006 and 7, the real estate. Us fighting inflation is nowhere as deep and as bad as those were. So we're long in the tooth now. We're setting, in our belief, Raymond James also, the global strategist, we're at the tail end of a bear market getting set up for the next bull market run. So, by the way, Max, I noticed the other day.
What'd you notice the other day?
I noticed they had these two basketball teams, and I got to throw this one in. It was the Miami, who was it?
Miami Heat against the Boston Celtics?
Boston Celtics. And who won that one?
Miami Heat. But I don't want to jinx it. Knock on wood, we get the series.
Oh, okay. I'll take the side. You want the Miami Heat to win?
Yeah.
Yeah. So, by the way,
game tonight.
The game. Oh, is tonight the final game
no,
of the playoffs?
There's game 2. It's a 7-game series.
Okay. Oh, I thought you. Never mind. Okay, so we got him a little one. But now here's the point that we're bringing those up. You would think that professional basketball players would know how to play basketball. Does Miami Heat have a coach?
Yes.
Why do they have a coach?
Because they need coaching. They need to master their skill.
Every team, every professional athlete, if you want to be the best, you need a coach. And I think I asked this before. Who's your number one golfer?
Let's just say Tiger Woods. Tiger Woods.
Well, no, you gave me a
Dustin Johnson.
There
is
we go.
The number one. I think he's leading the PGA this week.
See, Tiger's old news. We want new news.
Okay.
Okay. So does he have a coach?
Yes, he does have a coach.
If you want to really be outstanding in whatever you do, you need a coach. We're your financial coaches. Just look at this. You look to the far right. Average investor, 1.9%. I'll give him a break and call it 2. Look over in the middle. Average market returns, 6.1. We're going to call it 6. With the coach, the individual investor outperforms the average investor by basically 3 to 1. 2% versus 6%. That's what we're here. We take out the emotions. You know, you got to have a plan. I want to throw in this. You know, we see a lot of new clients that come in here and they'll bring in their portfolios. And I always ask these 2 questions. First question I ask is simple. All right, I see the portfolio. What is your buy discipline strategy? And what is your sell discipline strategy? And everything you need to know, a plan to do something. Max, what do you think? You know this. What's the answer? That's exactly the answer.
And I think the other thing too, Vic, is all these people, they prepare for retirement. I'm going to build this nest egg, and then they have no plan.
Absolutely.
And that's why they come to us, is for a plan, so we can create the plan.
Correct. You know, it was interesting. I saw a statistic the other day. More people will spend more time planning a vacation than they will spend planning their retirement. Whew. Okay. All right. So some key takeaways. You can do the odd, I'll do the even. You ready?
Ready.
Number one,
the arrival of the Fed's final rate hike.
Woo, one and done. Number 2, the fear of regional contagion has been contained.
Number 3, the housing market shows signs of major weakness.
Number 4, the debt ceiling will get resolved in the nick of time.
Number 5, history shows success comes from staying in, not from trying to time.
By the way, speaking of timing, who would you classify right now as the best well-known investor?
Victor Connor?
Oh, he's right about that. Or Warren Buffett?
Warren Buffett?
You think Warren times the market?
No.
You made a statement the other day I thought was interesting. Warren Buffett said the market should be open how many times a year?
Twice, when he wants to buy and when he wants to sell.
And the rest of it, he says, is noise. So we tie it all together. We look at the past, we look at the current, and we look at how you get things done. That's it. I hope you enjoyed this. We tried to get right to the point, tried to make this quick, yet informative, and always remember,
we're here looking out for you.
Thanks for joining us today.
But wait, there's more.
All right, summer. We got a number of seminars coming up. June 13th and 15th, live in Wellington, Florida. What baby boomers need to know about their retirement. It goes into depth on Social Security planning. And then
we have our 1-hour Savvy Cybersecurity seminars. We'll talk about what retirees need to look out for, what cybersecurity scams are happening, and what to look out for.
We'll give you samples and things to look out for because, unfortunately, they're all over the place. The next one, learn to craft your legacy. That's estate planning. Estate planning is more important than ever. And then finally,
Savvy IRA planning for bring your friends, and we'll talk about how to maximize their retirement in these IRA planning seminars.
Yeah, and a lot of it is, by the way, is timing when you take what money out from what area to do it in the most tax-efficient way. So that's it. And as always, remember,
we're here looking out for you.